Good evening, students, and welcome you all once again on a very important standard. And the name of this important standard is impairment of assets. Students, so after COVID, you will hear a lot about this standard in practical life as well, right? So before COVID or prior to COVID, although this standard has not gained a lot of momentum, but after COVID, this standard become very important for the practical life. I mean to say in industry, for the auditors, right? This standard plays a very important role. So let's talk about this standard, and before that, let's talk about what is the counterpart standard globally and in India prior to Ind AS. So this is not a new standard for us. Okay. So this Ind AS 36 impairment of asset is not a new standard for us. The counterpart standard in India was accounting standard 28, right? We have already read AS 28 impairment of asset. And this standard is 80-90% same with AS 28, right? As a concept is concerned. If I compare this standard with the global standard, this standard is a converged version of IAS 36, right? So International Accounting Standard 36 is a global standard which takes care of impairment of assets. So before discussing this impairment of assets, okay, so far we have already discussed a lot of asset-based standard like property, plant and equipment. So we have covered Ind AS 16, which is property, plant and equipment, which is a tangible assets. We have also covered Ind AS 38 intangible assets, right? We have also covered Ind AS 40 investment property. We have also covered Ind AS 2 inventory. So a lot of asset-based standard we have covered, right? And largely Ind AS 16 on property, plant and equipment, Ind AS 38 on intangible asset, and Ind AS 40 on investment property. When we read this standard, we found that there is a concept of depreciation and amortization, right? So the value of the asset will go down by charging depreciation or amortization on these standard, right? All agree with me? So depreciation and amortization concept we have already discussed. Now, what is the concept of impairment? Okay. What is the concept of impairment of assets? How the asset got impaired? As the name suggests, it is not a positive word, it is a negative word. Negative means impairment is something which is decreasing, which is reversing, which is decreasing the value of the asset, right? So depreciation and amortization, we have understood that why depreciation and amortization is required. It's like a wear and tear. The depreciation and amortization is required to be charged on the basis of efflux of time. So this depreciation, we all have understood. Okay. But what about impairment? Okay. So let's understand with the help of an example. And then I'll tell you what is the difference between depreciation and amortization and impairment. Okay. Right. So let me see who all are joined. Viraj, Selesh, Tanisha, Vanshika, Mufita, great Pooja, Rahul. So good morning, everyone. And to understand about this concept, let's discuss an example. So let's say Viraj has purchased a Maruti diesel car. Okay. And he belongs to Delhi, for example. And he purchased a Maruti diesel car, Swift diesel car, right? And he purchased that car at a value of rupees 10 lakh, at a price of rupees 10 lakh, right? So let's say the life of the car is 10 years. So what amount of depreciation he'll charge every year? What is the amount of depreciation? Assuming residual value is zero. What is the depreciation per annum? Right? 1 lakh rupees per annum. So what is the carrying value of the car at the end of the first year? 9 lakh rupees. What is the carrying value of the car at the end of second year? 8 lakh rupees, because 2 lakh rupees of depreciation has already been charged, right? Friends, at the end of 2 years, this car value is 8 lakh rupees. The carrying value of the car is 8 lakh rupees, right? And 10 lakh rupees the cost of the car, the life is 10 years. So we are assuming that every year the value has gone down by 1 lakh rupees, and at the end of the year, whatever is the carrying value, that is a true reflection of the market value, right? But what happens at the end of second year, the government in Delhi has banned the diesel car, and they said that the diesel car will not be allowed on Delhi roads after 6 months, right? Because of this increasing pollution, they told that the diesel car will be banned in Delhi after 6 months, not today, after 6 months. So this was the notification, this was the announcement by the government of Delhi. Now you tell me, please, just due to this announcement, whether the market value of this diesel car will drastically go down or will not go down. Whether the market value of the car will go down by this announcement? Of course, yes. It's a negative announcement. People will not buy diesel car. The second-hand car, people will also not buy, right? So the demand of the diesel car will go down, right? Or if people need to sell this car nearby state, in the other states, of course, it will have some transportation cost, right? And due to the value which is gone down in the principal market, in this Delhi market, of course the value will not so much in the other state as well, because there is an increase in supply, and there is a, of course, the demand is less. See, if I talk about this particular car, before announcement by the government of India or government of Delhi, just yesterday, I mean to say a day before announcement, whatever was the efficiency, whatever was the performance, whatever was the, feature of the car, it is still there. Whether after this announcement, do you think the efficiency of the car will go down? The performance of the car will go down? Of course, no. Of course, no. It will be same like before. If you will drive this car today, because government has told you 6 months, so the performance and efficiency of the car will not go down. Yesterday, if it was giving 15 kilometer per liter mileage, it will still provide 15 kilometer per liter mileage. It is still roadworthy. So everything is same. Everything is same. The car before 5 minutes before the announcement is as good as after the announcement. Nothing has been changed. There is no additional wear and tear in the car. But the value of the car has gone down just due to this negative announcement. What is that? What is that? And let's say the market value of the car, since the carrying value is 8 lakh rupees, and the market value of the car is 6 lakh rupees only. And it is 6 lakh rupees only, right? So friends, this 2 lakh rupee, what is this 2 lakh rupee? And of course, if the market value is 6 lakh rupees, you have to reduce your carrying value. You remember the formula of carrying value in Ind AS 16 and Ind AS 38 and 40? I have taught you that the carrying value is equal to cost minus accumulated depreciation minus accumulated impairment losses. Have you heard about that? Yeah. Cost minus accumulated depreciation minus accumulated impairment losses. Yes. So what is the term which we have to use for this decline in value, for this one-time impact? It is impairment. It is not depreciation. It is impairment, right? So the carrying value after depreciation is 8 lakh rupees minus 2 lakh rupees of impairment loss. Then 6 lakh rupees is your carrying value, right? So friends, so we have understood that this impairment is over and above than depreciation, right? Impairment is over and above than depreciation. Impairment is again an extra hit in the P&L. Extra hit in the P&L. It is over and above than depreciation, right? Right, friends? Have you understood this thing? So friends, if I compare between impairment and depreciation, so depreciation and impairment, depreciation is a systematic charge. Depreciation is a systematic allocation of depreciable amount over the useful life of the asset. Depreciation is a systematic charge, right? But impairment is one of, right? Impairment is one of. Like I have told you that depreciation is 10 lakh divided by 10, 1 lakh every year. But due to this government announcement, there is a one-time hit which came in, which is your impairment loss. Depreciation is a consumption based. It is on the basis of wear and tear, right? When you are using the asset, then you are depreciating the asset, right? But sir, you have told us that depreciation, even if you will not use the asset, if asset is available for use, then depreciation is required to be charged. Even if asset is available for use, then depreciation is required to be charged. Yes. So friends, consumption based does not mean that if only you are using the asset, then only you need to charge the depreciation. It is also on the basis of efflux of time. For example, if you have purchased the car and the life of the car is 10 years, because when you got the RC registration certificate, the expiry date of the car is also mentioned, right? Like in Delhi or in NCR, the petrol car has a life of 15 years. So it doesn't matter whether you will use that or you will not use that. This car life will expire after 15 years from the date of registration. Okay. So in that case, you have to charge depreciation every year on the basis of this efflux of time as well. Okay. When the time passes by, the future economic benefit, the expected uses of the time period of this asset will also go down. Okay. So depreciation is more of a consumption based. Either it is a use of the asset or by way of time, passing of time. But impairment is more of event based. Impairment is more of event based, right? Depreciation is a regular expense, as I told you, that's a systematic charge. But this is impairment is more like a one-time hit in the P&L, right? Friends, have you understood the meaning of depreciation and impairment? Have you understood the meaning of depreciation and impairment? Yeah, understood? Have you understood how this impairment is different from depreciation and amortization? Yes, friends. Yeah, very good. Very good. Right, Rahul. So Rahul is saying, sir, impairment not necessarily that impairment will be there every year. You are right, Rahul. But depreciation and amortization will be there every year till the life of the asset. Yes, you are right. Okay, let's move on the agenda. Friends, as far as agenda is concerned, of course, as I told you, that I'll touch upon the objective of the standard, the scope and meaning of impairment loss. Friends, this impairment, this impairment is not only a theoretical exercise. So when practically you will apply impairment, right? So impairment requires a lot of fair valuation. Impairment requires a lot of valuation, right? So it's a cost compulsive exercise as well as time consuming exercise. You have to engage a valuer who will do the valuation, right? So that valuer will of course charge a fee. That valuer will charge an amount. Okay. So if a company which is having a large setup like Reliance, like Adani, Godrej, Nestle, ITC, Bharti Airtel, like these telecom companies, they have a sites all across India, tower sites, right? They have 5 lakh tower, 3 lakh tower, 2 lakh tower in all the length and breadth of the country, right? Now the question arises, sir, if we need to do the impairment, do we need to check the impairment every year, right? Because it's a requirement that you have to also check the impairment. So, sir, whether we need to engage the valuer every year, every reporting date, we need to engage the valuer and carry out this impairment exercise? Answer is no. Friends, that is why the standard says that you need to identify the asset which may be impaired, right? So before carrying out a detailed impairment exercise, you need to identify an asset that may be impaired, right? We'll talk about that, how to identify an asset that may be impaired. Then we'll talk about the measurement of recoverable amount. Measurement of recoverable amount. Okay. measurement of recoverable amount, recognition and measurement of impairment loss. As I told you, there are four pillars of accounting: recognition, measurement, presentation, disclosure. RMPD. RMPD. So we'll talk about the recognition of impairment loss, the measurement of impairment loss, the presentation and disclosure of impairment loss as well, right? Friends, in this standard, we'll talk about two kind of impairment, right? One, impairment of individual asset and impairment of group of asset. Impairment of individual asset and impairment of group of asset. Friends, impairment of individual asset is an asset impairment. But what is the term which is used in this standard for the impairment of group of asset? You have already heard about that term in your accounting standard 28 as well. Can you tell me what is the term which is used in this standard for the impairment of group of assets? So what is the term which is used for group of asset in this standard? You are right, Neha. It is CGU, cash generating unit. So we will be discussing the impairment of individual asset as well as cash generating unit in this particular standard, cash generating unit, CGU. Right? We will be talking about CGU impairment, okay? And we will be talking about goodwill and the concept of corporate assets in this particular standard. Right, friends? Then, friends, in case of a group of asset, in case of a cash generating unit, how to allocate an impairment loss in the assets of a group of asset, right? In the between the assets of a group of asset, okay? And we will be talking about the reversal of impairment loss as well. Then we will be talking about the disclosures. Okay. So this is the agenda of this particular standard. If I brief the agenda, first of all, we'll talk about the identification of an asset that may be impaired. We will be discussing how to measure a recoverable amount. Recoverable amount means the assets amount, the value of the asset which can be recovered, right? And when we compare the recoverable amount with the carrying value, if carrying value is higher than the recoverable amount, then there is a impairment losses. Okay. We will also be talking about the concept of cash generating unit and corporate asset, and we will be discussing the allocation and reversal of impairment loss. So these are the 4-5 agenda in this particular standard. Coming to the objective of the standard, this standard ensure that assets are carried at no more than their recoverable amount. Friends, what is the objective of impairment of asset standard? What is the objective? The core objective is, let's say if you have recognized your machinery, your vehicle at X amount, at 10 lakh rupees. This is the carrying value of your asset in the books of accounts. So the core objective of this standard is whatever you are showing in your books of accounts, right? Your recoverable value should not be lower than that amount. Simple thing. Simple thing is your recoverable value is not lower than whatever you are showing in the balance sheet. That's the only thing. If your recoverable value is lower than whatever you are showing in the balance sheet, in that case, impairment of asset will come into picture. You have to impair that asset because the primary objective is the users are taking a decision on the basis of their balance sheet, right? So it will give a bad picture. It will not give a right picture if the assets value which you are showing is at 10 lakh rupees. However, the market value is only 8 lakh rupees. So the users may draw an inference, oh, the asset value is 10 lakh rupees for this company, but the actual value of the asset is not 10 lakh, it is only 8 lakh rupees, right? So that is why this standard come into picture, which provides more conservatism, and it says that you have to apply the law of conservativity, and you have to take your value down to the recoverable amount. You have to take your value down to the recoverable amount. Then determination of recoverable amount. This standard talks about how to determine the recoverable amount. Then allocation and reversal of impairment loss. Allocation and reversal of impairment loss. And then this standard talks about the disclosure. This standard talks about the disclosure, right? So friends, this is the objective of the standard. The primary objective is the value of the asset in the balance sheet should not be more than the recoverable value. If it is more than the recoverable value, then you have to charge an impairment loss and take this carrying value down to the recoverable value. Right, sir? What is the recoverable value? We'll talk about that. Objective is pretty clear. Now coming to the scope. Ind AS 36 applies where? Friends, when you gone through with the inventory standard Ind AS 2, what was the rule of inventory measurement? What was the rule of inventory valuation at the reporting date? Cost or NRV, whichever is lower. If cost is 100 rupees, NRV is 80 rupees. What is lower? 80. You have to reduce the inventory to 80 and you have to recognize an impairment loss. This is what we discussed in Ind AS 2. The same concept was there in AS2 as well, right? This is what we discussed. Friends, although this 100 to 80, this 20 rupee reduction is known as an impairment loss because there is no depreciation on the inventory. So this 20 rupee reduction is known as impairment loss. But the point is, should I say that this impairment loss is as per Ind AS 36? Answer is no. Answer is no. So the reduction in the value of the inventory by cost to NRV is taken care by Ind AS 2 itself. It is not as per Ind AS 36. Second example, impairment on financial assets. Impairment on financial assets, right? Let's say the value of the investment is 100 rupees, but the market value has gone down to 70 rupees. Of course, you need to reduce your value of investment. You have to recognize a mark-to-market loss of 30 rupees. Whether this mark-to-market loss, what is that? Of course, that is an impairment. That is a reduction in value. That is an impairment. Whether this 30 rupees of decrease in value of investment, whether this 30 rupees of decrease in value of investment will be considered as a impairment loss under Ind AS 36, answer is no. The impairment on financial instrument is taken care by Ind AS 109. Is taken care by Ind AS 109, financial instrument standard. So the point is, there are assets, there are standards, there are assets where the impairment loss on those assets will be taken care by the respective standard. Third example could be deferred tax asset. Let's say the company has recognized a deferred tax asset on the losses they have incurred, right? And why the company has recognized deferred tax asset on the losses? Because the company foresee that in future we have a profit and we will be able to adjust these losses into the profit with the profits, right? And that is why the company has created a deferred tax asset. Now the question arises, sir, if tomorrow the company will able to foresee that no, the company will not be able to realize the profit for the next 8 to 10 years due to XYZ reason. Of course, this deferred tax asset need to be reduced. Deferred tax asset need to be reversed. This deferred tax asset needs to be zero. Sir, is it an impairment? Answer is yes. This is an impairment. Sir, whether this reduction of deferred tax asset or impairment of deferred tax asset will be covered under Ind AS 36, answer is no. It will be covered as per Ind AS 12, which is income taxes standard, right? So if you are reducing the value, if value of the asset is going down, that is an impairment. But whether the decline is covered under Ind AS 36 or respective standard, you need to look at, right? So there are a lot of assets where the reduction in value has to be taken care by the respective standard, right? Friends, in this standard, the negative list is given. But let me give you a constructive list. Normally, Ind AS 36 applies to 4 assets, normally. property, plant and equipment, intangible assets, investment property and goodwill. Normally, the Ind AS 36 applies to 4 assets normally. PP, intangible asset, please write down PP, intangible asset, investment property and goodwill. Impairment on all other assets is generally taken care by the respective standard. So this Ind AS 36 applies to all assets except inventory, that is taken care by Ind AS 2, contract asset and contract asset and asset arising from cost to obtain or fulfill a contract, Ind AS 115, deferred tax asset Ind AS 12, asset arising from employee benefit Ind AS 19, illogical asset Ind AS 41, deferred acquisition cost Ind AS 104, non-current asset classified as held for sale Ind AS 105, financial assets Ind AS 109. So friends, on all these assets, the impairment is covered in the respective standard, right? On all these assets. For all other assets like PP is not here, intangible asset is not here, investment property is not here, goodwill is not here. On these 4 assets, impairment on these assets is covered by Ind AS 36. PP, intangible, investment property and goodwill. Right? So this is the list which is given in the standard. Now, sir, what is meant by impairment loss and what is meant by recoverable amount? Okay. So let's discuss the important and the first meaning and definition of recoverable amount and impairment loss, right? Okay. What is meant by impairment loss? Impairment loss is the amount by which the carrying amount of an asset or a cash generating unit exceeds its recoverable amount. Friends, wherever you find cash generating unit, just read like a group of asset. So what is the impairment loss? Impairment loss is the amount by which the carrying amount of an asset or a group of asset is exceeding, is more in comparison to the recoverable amount. For example, in that example of a car where the carrying value at the end of 2 years was 8 lakh rupees. You remember the cost of the car was 10 lakh rupees, that Viraj's car, Maruti diesel car. The cost was 10 lakh rupees. The life was 10 years. First year the carrying value was 9 lakh. Second year the carrying value was 8 lakh. Okay. So the carrying value was 8 lakh rupees. But due to that government announcement, the market value becomes 6 lakh rupees. When Viraj went to Kirtinagar market to sell that car, the dealer was saying that we will only pay 6 lakh rupees. So friends, what is the carrying value of this car? 8 lakh rupees. What is the recoverable value of this car? 6 lakh rupees. So carrying value is higher than the recoverable value, right? Your carrying value is higher than the recoverable value. So now you have to reduce your carrying value and make it equal to the recoverable value. You have to reduce your carrying value to the extent of recoverable value. In that case, this reduction is nothing. It's known as an impairment loss, right? So carrying amount minus recoverable amount is equal to impairment loss. Carrying amount, if carrying amount is greater than the recoverable amount, carrying amount is greater than the recoverable amount, right? Then there is a impairment loss. And how to compute that impairment loss? Carrying amount, for example, 100 rupees. 100 rupees your carrying amount, 80 rupees your recoverable amount. Okay. Then what is your impairment loss? 20 rupees your impairment loss account debit in the P&L to asset account. This is the calculation, meaning, definition of impairment loss. Is that clear, friends? Is that clear? Clear, not clear? Is it clear, not clear, friends? I hope it is clear to all of you. Is it clear to all of you? So if your carrying amount is greater than recoverable amount, then only there is a situation of impairment. If your carrying amount is lower than recoverable amount, it is more conservative. You are saying that, let's say you have purchased a land at 1 crore rupees. The value of the land is become 10 crore now. The market value is 10 crore and you are following a cost model. That can be possible, right? So remember, you are following a cost model because cost model is allowed. So you can carry your land in the balance sheet at 1 crore rupees only. However, the market value is 10 crore. So if you're not opted for revaluation model, right? Or if the land is an investment property, then you have to carry it at cost. But for the same land, if the market value has gone down to 80 lakh rupees, then following the rule of conservativity and following this impairment loss standard, you have to reduce the carrying value to the extent of it become a recoverable value. You have to recognize an impairment loss. Okay. Right, friends? Shall I move forward? Very good. Now, sir, what is meant by recoverable amount? We understood as the meaning is concerned, we understood the recoverable amount means the amount of the asset which can be recovered in the market, right? Or we can say that recoverable amount is nothing. It's like a market value. It's like a fair value, right? Sir, what is the meaning of recoverable amount in the context of Ind AS 36? Recoverable amount of an asset or a CGU is what? It is the same definition which we have already read in AS 28. What is the meaning of recoverable amount? Recoverable amount of an asset or a CGU is the higher of what? Higher of its fair value less cost of disposal, which is fair value less cost of sale, fair value less cost to sell, and its value in use. It means, sir, for calculating recoverable amount, we need to compute two values. What is the fair value less cost to sell and what is the value in use, right? So then only we will be able to compare what is higher, who is higher, and then that higher will be your recoverable amount, right? This is what it is given in the standard. Fair value less cost of disposal and value in use. Okay, right? Friends, higher of fair value less cost to sell and value in use. Now the question comes, sir, what is meant by fair value less cost of disposal? So fair value means market value. Cost of disposal means if today, let's say in that car example, if today I will sell my car, right? 6 lakh rupees the market value, but I need to pay some transfer charges, right? And the buyer is saying that the transfer charges has to be borne by you, which is a seller. For example, the transfer charges of this car is 25,000 rupees. So 6 lakh minus 25,000, that is 5,75,000 is my fair value less cost of disposal. 5,75,000 is my fair value less cost of disposal, right? So that is number one, fair value less cost of disposal, 5,75,000. Okay. So we understood this fair value is nothing, it's a market value, right? Means if today you are going to sell your asset in the market, what value you will fetch by selling that asset into the market? What value you will fetch by selling that asset in the market? Means fair value is governed by the market participants. Fair value is a broad word which is governed by the market participants, right? So this first leg, fair value less cost to sell, the fair value is determined, or fair value is a value which is determined by selling the asset into the market. So fair value is a value which is arrived by selling the asset. Sir, what is meant by value in use? Please tell me, what do you understand by value in use? As the name suggests, value in use means if you will compare just by the English name, by the English terminologies, here it is talking about disposal. It means fair value is a value which you will arrive, which you will fetch once you sell the asset. But value in use, it means if I will use my asset, then what is the fair value? What is my value if I'll use the asset. So fair value less cost to sell will be arrived by selling the asset. It means if you go to the market and sell the asset. But value in use will be computed or calculated if you will use the asset for the lifetime, for the economic life of the asset, then what the value you will get for that asset, right? Friends, you remember the concept of operating lease and finance lease? You remember the concept of that finance lease in AS 19? How many of you remember the concept of finance lease in AS 19? How many of you remember the concept of finance lease in AS 19? Yeah. What is the concept of finance lease? The concept of finance lease was, you remember, there was some indicator which was given for the finance lease, like if the lease term of the asset, if the lease term is if the lease term is equal to the economic life of the asset or major part of the economic life of the asset. For example, if the major part of the economic life, if the life of the building is 20 years and the lease term is also happening for 20 years, then it is a case of finance lease. And you remember, in case of finance lease, the lessor de-recognize the asset in its balance sheet, and lessor recognizes the lease receivables, and lessee recognize the asset in the balance sheet, right? And one of the condition was also that in case of a finance lease, largely the lease rental, the present value of the lease rental is largely equal to the fair value of the lease asset, right? So friends, what is that present value of the lease rental? It is just like a value in use. It is just like a value in use. If my asset, my building today is worth 50 lakh rupees. So let's take an example of this to understand fair value concept and value in use concept. Friends, today the value of my building is 50 lakh rupees, right? And when I'm saying 50 lakh rupees means today, if I will sell this building in the market, if I'll sell this building, I'll get 50 lakh rupees. That is my fair value. Okay. The life of my building, is 20 years. Okay. If I will not sell this building, but I will use this building for the purpose of rental, for the purpose of earning rental, I will get 5 lakh rupees. I will get 5 lakh rupees every year from the rental income. Right? So I'll get 5 lakh rupees every year, means I'll get 5 lakh rupees for 20 years from this building. Right? So since I don't want to sell this building, since I'm using this building, so how I will get the value in use? So standard says that value in use means present value of future cash flows. What is my future cash flow? My future cash flow is 5 lakh rupees every year. What is my present value? If I discount my 20-year cash flow as on date, I will get present value of future cash flows. I will get present value of future cash flows, right? And let's say this present value of future cash flows is, for example, comes out at 40 lakh rupees, right? So this is known as value in use. So value in use means a value which will be arrived by using the asset. And how you will getting that value? By discounting the future cash flows to the present value, right? Present value of future cash flow is considered as a value in use. Present value of future cash flow is considered as a value in use, right? Is that clear, friends? Is that clear? I hope it is clear. Yes. So fair value is a market driven term. Value in use is a value which will be arrived by using the asset. So fair value is a market driven value. Value in use is an entity specific value. Value in use is a entity specific value, right? What entity will, what cash flow entity will receive by using that asset. So value in use is an entity specific value. Okay. Fair value is a market driven value. It's a broader term. Okay. Fair value is arrived by selling the asset, by expectation of selling the asset. Value in use is arrived by using the asset. For example, in this case, if I'll use the asset, means I'll hold the asset for running rental. Whatever my present value, future rental is there, that is the value in use of that asset. So in this case, 50 lakh is fair value. Present value, future rental is 40 lakh. What is higher? 50 lakh is higher. So in this case, recoverable amount is 50 lakh rupees, right? Recoverable amount is 50 lakh rupees. Is that clear, friends? Is that clear? Clear, not clear? Clear? So quickly discuss this case study. The carrying value of a building in the books of ABCL Limited as on 31st March 16 is 250 lakhs. This is your carrying value. As on that date, the value in use is 200 lakhs and fair value less cost of disposal is 188 lakhs. So carrying value is 250 lakhs. Fair value less cost to sell is given, which is 188, and value in use is 200 lakhs. Calculate the impairment loss in the books of ABC Limited. Friends, you need to tell me what is the recoverable value in this question. What is the recoverable value? Tell me quickly. Your fair value less cost to sell is given, your value in use is given. What is the recoverable amount in this case? What is the recoverable amount in this case? Can you tell me what is the recoverable amount? Yes, it is higher of fair value less cost to sell and value in use. So the recoverable amount is 200 lakhs. The recoverable amount is 200 lakhs. If the recoverable amount is 200 lakhs, then what is my carrying value? It's 250 lakh. What is my impairment loss? My impairment loss is carrying amount minus recoverable amount, right? So in this case, my carrying amount is 250 lakh. My recoverable amount is 200 lakhs. So 50 lakh will be my impairment loss. Is that clear, friends? Is that clear? Yeah, very much clear. Okay. So friends, let's go to the Excel file and please confirm if my Excel file is visible. Please confirm if my Excel file is visible. Is that visible? Yeah? Okay. So friends, objective scope we have discussed. Recoverable amount we have discussed. It is a higher of fair value less cost to sell and value in use, right? We have discussed that fair value less cost to sell is a market driven value and value in use is an entity specific value. In this case, the fair value less cost to sell, this is a value which can be derived from exit point of view. It is from selling the asset. When you're exiting from the asset, means you sell the asset, then what value you will fetch from the market? And this value in use will be derived from the continuance point of view, means you will continue to use the asset. You will continue to use the asset. In that case, how the value can be derived, right? This is an entity specific value. Fair value less cost of disposal, right? So this fair value less cost to sell is simple. When you reduce your cost of disposal from fair value, you will get fair value less cost of disposal. But entity specific value, how you will arrive at? This is your present value of future cash flows. This is your present value of future cash flow, right? Present value of future cash flow. Is that clear? So just now we have just done a very small case study of this 250 lakh of carrying value, 188 lakh of fair value, 200 lakh of value in use. So the higher was 200 lakhs, right? In that case, the higher was 200 lakhs. Okay. And when we compare 250 with 250 lakh was impairment loss, right, friends? So recoverable amount is a higher of fair value less cost to sell and value in use. Friends, how to compute this value in use? That is very simple. So quickly, I'll explain you once again quickly. For example, the company is is leasing the machinery on rental basis. On rental basis. Remaining life of the machine is 5 years. Yes. The company expects 1 lakh rupees of rentals by leasing for the next 5 years. Discount rate, the discount rate is 10%. Compute value in use of this asset. How to compute value in use? It is a present value of future cash flow. What is my future cash flow? Here, my future cash flow, can I write it? FCF, future cash flow, FCF, future cash flow. This is 1, 2, 3, 4, 5. These are the years. Okay, this is my future cash flow. What is my present value factor? Discount rate. What is my discount rate? It is 10%. So can I write 1 divided by 1.1? This will give me the discount factor for the first year. Right? Likewise, if I need to compute the discount rate for the next year, divide by in 1.1, right? Same way, I'll get the discount factor for the 5 years. And what is my present value? Present value, PV. My PV is when I multiply this with this, I'll get the PV. And when I total it, this is my total. This is my total. So what is my value in use? My value in use is equal to 379079. 37907. Right? Right, friends? In this example, let's say I'll give you more information. The fair value of this machine is rupees 4 lakh, and the carrying value is and the carrying value is 3 lakh 53.5 lakh, and the carrying value is 3.50 lakhs. Friends, and the question says that calculate impairment loss. Value in use we have computed. The fair value of this machine is 4 lakh, and the carrying value of this machine is 3.5 lakh. Calculate impairment loss. Tell me quickly what is the impairment loss. Tell me quickly what is the impairment loss, friends. I am just giving you 30 seconds. In this question, you need to tell me what is the impairment loss. I need a quick answer. How much impairment loss will be there in this question? How much impairment loss will be there? Mufita is saying 50,000 rupees impairment loss will be there. Okay. What about others? Friend, this is how you will make an error in the exam itself. You are not going by the concepts, right? What concepts I have told you? You need to compare your carrying value. You need to compare your carrying value with the recoverable value. And what is the formula of recoverable value? It is a higher of fair value less cost to sell and value in use. So let me see how many have given the right answer. Abdul is saying 0. Okay. Mm-hmm. Supraja is saying again no impairment loss. Mufita is saying no impairment loss. Samangi is saying sir 50,000. Supraja is saying because recoverable amount is greater than carrying amount. Yes, Supraja, you are right because recoverable amount is greater than carrying value. There is no impairment. Yukta is also saying sir there is no loss because carrying value is already less than recoverable amount. Very good. Dara Siva is also saying carrying value is more, so no loss. Okay, right. So in this particular case, whomsoever has told that no loss, they are right. In this case, first of all, what is the carrying value? Solution. Simple. What is your carrying value? The carrying value is given in the question for 3,50,000, right? 3,50,000. What is the recoverable value? Recoverable value. Recoverable value is equal to higher of fair value less cost to sell and value in use. What is my fair value less cost to sell? What is my fair value less CTS? This is 4 lakh. What is my value in use? This is 379079. Okay. 379079. What is my recoverable amount? My recoverable value is equal to, this is equal to how much? This is equal to higher of fair value less cost to sell and value in use. This is equal to 4 lakh. This is equal to 4 lakh. Right. So now your carrying value is already less than recoverable value. Means your value, recoverable value is already higher. There is no impairment. In this case, in this case, in this case, since the recoverable value is higher than the carrying value, there is no question of impairment. This is how you need to answer this question. There is no question of impairment, right? Because your carrying amount is already less than the recoverable amount, or recoverable amount is already higher than the carrying amount. There is no impairment at all. No impairment, nothing. Right, friends? Is that clear? Is that clear? Sir, let's say I have computed in this particular question, for example, the carrying value is 3,50,000 and I have computed the market value. Market value comes out at 4 lakh. Market value is already higher than the carrying value. Whether I need to compute the value in use, answer is no. If you compute 1 lakh, which is either fair value less cost to sell or value in use, and if it become higher than your carrying value, then there is no requirement of computing the other value because the concept is higher. Even this other value will be lower. Still, you will take the higher. Are you getting me? Are you getting me? So in the practical life, what companies are doing, the companies are making a projection that how much money, how much cash flow they will get in future, right? And they will do the discounting on the basis of incremental borrowing rate. If they will get the value in use number more than the carrying value of the asset, in that case, they are not getting this fair value computed by the valuer, right? They are not going into that. Why? Because already 1 lakh is higher than the carrying value. It means it is sure that minimum value is this much. Means impairment will not be there. Are you getting me, friends? But if this value in use is lower than the carrying value, then probably they will go for the market valuation, right? Probably if the market valuation become higher, then they will avoid the impairment, right? Clear? Is that clear or not clear? Clear in mind? Is that clear in mind, friends? So please remember, if either of the value, like fair value first you computed or value in use first you computed, if any of the value become higher than the carrying value, there is no requirement of, there is no requirement of computing the other value. Is that clear? Okay. Friends, now let's talk about the next part. So far we have understood this thing, what is your recoverable amount, what is your impairment loss. So we have already understood these things, right? Now let's talk about the next part. Identification of an asset which may be impaired. As I told you that this impairment exercise is a time consuming as well as cost compulsive exercise. Okay. It's not like that every year you should start, looking for the impairment. It's not like that. Standard says that an entity is required to assess at the end of each reporting period. At the end of each year, the entity is required to evaluate, is there any indication that an asset may be impaired, right? So once in a year or at the end of every reporting date, the company need to check. For example, I have an asset. This is my mobile. Mobile is my asset. At the end of every reporting date, on 31st March, I will assess, is there any indication that my mobile may be impaired? Is there any indication? Sir, what indication? We will discuss. But for the time being, I'm not doing an impairment testing. I'm just asking, I am asking the simple question. Is there any situation? Is there any indication which exists that this asset may be impaired, right? If that indication exists, then only you need to estimate the recoverable amount. Then only you are required to do the impairment testing. Right, friends? Sir, what is the impairment testing? Impairment testing means you need to estimate your fair value less cost to sell. You need to estimate your recoverable amount. This is known as a impairment testing, right? So one thing is very clear, sir. It means if the indication does not exist, then you are not required to do this impairment testing. You are not required to compute value in use. You are not required to compute fair value less cost to sell. Right? You are not required to get through all those valuations. Okay, friends? Is that clear? Is that clear? Okay, so let me take you again on this Excel file and please confirm if the Excel file is visible. Excel file is visible. We are talking about identification of an asset that may be impaired. Identification of an asset that may be impaired. So at the end of each reporting period, at the end of each reporting period, right? At the end of each reporting period, management should check if there is any indicator of impairment. Management should check if there is any indicator of impairment, right? There is any indicator of impairment. If the impairment of indicator exists, do the impairment testing and estimate the recoverable amount. As simple as this. If any indicator exists, then do the impairment testing and estimate the recoverable amount. Right? Do the impairment testing and estimate the recoverable amount. Is that clear? Is that clear, friends? I hope it is clear to all of you. At the end of each reporting period, management should check if there is any indicator of impairment, if there is any indication of impairment. If indicator exists, then you need to do the impairment testing and estimate the recoverable amount. Right? Okay, sir. We have understood this thing. We have understood this. Now, friends, I'm taking you again on this PowerPoint presentation. So, friends, we talked about that this detailed impairment exercise, impairment testing, estimation of recoverable amount will be required only when there is an indicator of impairment. Is that clear? Right? Is that clear? But friends, there are three exceptions to it. There are three exceptions to it. Sir, what is meant by exception? Exception means the rule which I have talked about, that you are required to do the detailed impairment exercise only when the indicator of impairment exists. If indicator of impairment does not exist, you are not required to do this detailed impairment exercise. But in three cases, you are not required to wait for the indicator of impairment. Means in the three cases, you have to carry out mandatory detailed impairment exercise in the three cases. So irrespective of whether there is an indication of impairment or not, an entity shall test annually for impairment of asset. An entity shall an entity shall test annual impairment testing for three assets. Which are these three assets? All these three assets are intangible assets. First of all, which are these three assets? Number one, intangible asset with an indefinite useful life. Intangible asset with an indefinite useful life. Intangible asset with an indefinite useful life. You remember, while while teaching in days 38 intangible asset standard, I told you guys that there are definite life, which is finite life, and the concept of indefinite life in intangible asset. Whenever there is an indefinite life, of course, you cannot compute depreciation or amortization. You cannot compute amortization. Why? Because you don't know the life. In that case, there is a manually. In that case, there is a mandatory. In that case, there is a mandatory impairment testing which is required at the end of every year, right? If you're not amortizing, you have to compute, you have to do the impairment testing exercise on a regular basis, which is on a yearly basis. It is a mandatory, right? It is mandatory. Second, intangible asset not yet available for use. So you have already acquired an intangible asset, but you are not able to use the intangible asset. For example, you have acquired a formula, right? You are not using the formula because the demand for that medicine has gone down. A pharmaceutical company has, so pharmaceutical company has, so basically, or I can say that when intangible asset not yet available for use, I mean to say it is under work in progress, under development condition, right? If it is an intangible asset under development, so how will you amortize since it has not been capitalized? So in that case, again, impairment testing is required. Third, goodwill arise in business combination. You have acquired a goodwill. Acquired a goodwill means you have acquired a company, you have acquired an asset, you have acquired a group of asset, you have acquired a business, you have acquired a company. And by acquiring the entity or the company or the business, you have paid some premium. And that premium is nothing, it's a goodwill. It's a goodwill, right? So you have acquired a goodwill. I can say that. So friends, that goodwill which you have acquired, right? So there is a mandatory impairment testing is required for that goodwill also on a annual basis. So friends, there are three assets: intangible asset with an indefinite useful life, intangible asset under development, or I can say that not yet available for use, goodwill arise in business combination. There are three kind of intangible asset which requires mandatory impairment testing, which requires mandatory annual impairment testing, right? These three assets requires mandatory annual impairment testing. Is that clear? Is that clear, friends? Is it clear? Very good. So what was the rule? Rule was, rule was, first of all, the rule was impairment testing is required only when, it is required only when there is an indicator of impairment. But for 3 cases, even though the impairment indicator is not there, still you are required to carry out the detailed impairment exercise. Detailed impairment exercise, right? So now Viraj has a question. So Viraj, I'll answer your question. I'll answer your question after explaining the indicator of impairment, okay? And or after explaining this concept of this exception, right? After explaining the concept of this exception. Friends, now the question arises, sir, we understood that on these 3 cases, there is a manual impairment testing. There is a mandatory impairment testing which is required. There is a mandatory impairment testing which is required. So let's say if the company is, whether the company is required to do this impairment testing on these 3 assets once in a year or once in a year or more within a year. For example, it is more frequently or once in a year it is sufficient. Standard says that the impairment testing is mandatory at least once in a year, at least once in a year, right? And number one, it is mandatory at least once in a year. Sir, whether it has to be at the end of the year always or the frequency or timing may be different. For example, sir, let's say if I want to do this impairment testing in the third quarter, in Q3, right? Can I do that? Answer is yes. Standard says that yes. But whatever frequency you adopt, right? For example, this year you are doing on in the third quarter, in Q3. In the next year, for this asset, again you need to do this impairment exercise in Q3 only, right? So friends, standard says that you need to carry out this impairment exercise at least once in a year. At least once in a year. Right? You need to carry this impairment exercise at least once in a year. Right? And this once in a year could be in quarter 1, quarter 2, quarter 3, quarter 4, whatever you want. Whatever you want. But this frequency should be consistent on a year basis. For example, a company has done the impairment testing of an intangible asset which is having an indefinite life in the quarter 4, which is March quarter, right? And the company has recognized the impairment. Since it is an intangible asset having indefinite life, it is a mandatory requirement to do the impairment testing. And in the next year, the company does not want to book any impairment loss, because the company knows that my value becomes lower. So company don't want to recognize the impairment loss once again in the next year. So what management does? The management said that, okay, recently we have done this impairment exercise and recently we have booked an impairment loss in quarter 4. So let's do one thing. Do the impairment exercise in quarter 1 only, right? So that we will not have any impairment loss, because recently अभी हम लोगों ने impairment assessment किया है, उसके according आपने impairment loss book कर लिया. So when I do this impairment exercise after 2 months, probably I will not have any 2 months or 3 months. I will not have any impairment loss. I will not have any impairment loss, right? The value will be quite similar. So friend, standard says that no, you can't play like this. If you have carried out your impairment exercise for this intangible asset having indefinite life in Q4, again you have to carry out in the next quarter 4 only. If you have done in quarter 3, again you have to carry out in the quarter 3 only. Right? Sir, let's say if the company is a listed company and they are doing a reporting on a quarterly basis, so their reporting date is 4 times in a year. Answer is yes. Sir, if these companies have an impairment indicator, right? If these companies have an impairment indicator, in that case, whether they have to do this impairment testing more frequently, answer is yes, right? Even it could be 4 times in a year. Even it could be 4 times in a year. Right, friends? So, friends, please remember 3 things. Number 1, impairment testing is required only when there is an indicator of impairment. That is, please write down. Please write down point number one. Impairment testing is required only when there is an indicator of impairment. Number two, please write down. Number two, impairment testing on three assets, three, which is intangible asset having indefinite life, intangible asset not yet available for use, goodwill arising in business combination. Impairment testing on these three assets is required even though impairment indicator is not there, right? Impairment testing on three asset is required to be done mandatorily, right? Once in a year, even though impairment indicator does not exist, right? Point number three. Point number three. If there is an indicator of impairment, the impairment testing may be more frequent, which may be more frequent, like twice, thrice, or four times in a year. For example, for listed companies, the impairment testing may be carried out four times in a year. That is in 4 quarters. Like because they are reporting on a quarterly basis. Right, friends? I hope it is clear to all of you. Raj, is that clear? Okay. So friends, let me take you on the Excel file, and please confirm me if the Excel file is visible. So now I'll discuss these exceptions, which I have already discussed. Right? So what is the exception of this rule? That the indicator will be there, then only impairment testing is required. This is in case of three assets, impairment testing is required irrespective of the indication of impairment, right? There are some notes which I have told you. What are these notes? Impairment testing is mandatory on the above three assets at least once in a year. The frequency of the timing of impairment testing should be consistent on a year-on-year basis. For example, let's take an example. This is FY 2021 and FY 21-22, right? Intangible asset having indefinite life. So this impairment testing has been carried out in Q3. In the next year, it has to be in Q3 only. This is a second kind of intangible asset not yet available for use. The company has done the impairment testing in Q2. This has to be carried out in Q2 only. This is goodwill. The impairment testing of the goodwill has been carried out in Q1. This has to be carried out in Q1 only. Right? So this has to be consistent. Same frequency should be there. Consistent from one period to another. Note number C. Intangible asset having indefinite life is acquired in January 22. Whether impairment testing is required on this asset in FY 21-22. Friends, in financial year 21-22, in the month of January, it means in the last quarter, in the month of January, the company has acquired an intangible asset which is having an indefinite life. Right? Now you need to tell me whether impairment testing is mandatory on this asset in FY 21-22. Whether impairment testing is mandatory on this asset in FY 21-22. It is purchased just 2 months ago or 2.5 months ago. What do you think? Is it mandatory? I am waiting for the answer. Muhammad Abdul is saying, yes, sir, it is required. Yes, you are right, Abdul, it is required. Because the standard says that once in a year. And when I'm talking about year, it's a financial year, right? So yes, the impairment testing is mandatory at least once in a financial year. At least once in a financial year, right? So even though this asset is acquired in January, it does not mean that you have to do the impairment testing in January. You have to do the impairment testing in the month of March at the end of the reporting date. Yes, impairment testing is mandatory at least once in a financial year. Right, friends? Right? Okay. Let's move to the next concept. Let's move to the next concept. Sir, you have told that if indicator of impairment exists, then only you are required to do the detailed impairment testing. And you need to estimate a recoverable amount. Sir, what is indicator? Is it like left indicator, right indicator of a car? Yes, it is just like that. It in impairment of asset standard, it is a internal indicator as well as external indicator. Internal indicator means indicator within the company. External indicator means outside the company. For example, if the government has banned the output from a machinery, or government has announced that the diesel car will be banned in Delhi. So what is that? Is it an internal indicator of impairment or external indicator of impairment? Of course, it's an external indicator of impairment because it is not an announcement within the company. It is an announcement outside the company, right? It's an external indicator. So friends, standard says that if there are indicator which exist, if there are internal indicator, external indicator which exist, right? In that case, you have to carry out the detailed impairment exercise. What could be the example of these indicators of impairment? For example, evidence of obsolescence or physical damage, right? Evidence of obsolescence or physical damage. Let's say an entity has purchased a car and the entity capitalized this car as a fixed asset, as a property, plant and equipment, right? After after 6 months, this car met with a huge accident, big accident, and this car got physically damaged, right? So when this car met with an accident, and of course this entity will repair this car, right? The entity has also got the insurance claim. But since this car has met with an accident, don't you think the value of the car will go down? Yes, yes. The value of a non-accidental car versus an accidental car, of course, the value is different, right? Let's say if you want to buy this second-hand car, will you buy that car which met with so many accident, or will you want to buy that car which does not have met with any accident, right? Sir, how can we know about that? Of course, you look at your insurance premium papers and all, right? But don't go by that. Just think about if your machinery, your asset, your car is physically damaged, don't you think it is an indicator that you need to carry out a detailed impairment exercise? I'm not saying, friends, again, don't get confused that if there is an indicator of impairment, it means that impairment will be there. Not necessarily. But if the indicator of impairment is there, you need to carry out a detailed impairment exercise, means you need to estimate the recoverable amount. That's all. Right? So the evidence of obsolescence or physical damage is an internal indicator of impairment. Indicator. I'm not saying it is yes, it is indicator. Asset remaining idle. The company is not able to use the asset. It is remaining idle. It is again an indicator of impairment. Discontinuance, disposal or restructuring plans. The company wants to shut down the factory. The company wants to relocate the factory. So these kind of discontinuation, disposal, restructuring plans, these are again an example of internal indicator of impairment. Declining asset performance. Earlier your car was giving a mileage of 15 kilometer per liter. Now it started giving a lower mileage. It is giving 12 kilometer per liter mileage, 10 kilometer per liter mileage. It means it is a declining asset performance. It is a declining asset performance, right? It is again an internal indicator of impairment. It is again an internal indicator of impairment, right? External indicators. External indicators. What is an external indicator? Significant decline in market value. Significant decline in market value. It is an external indicator of impairment, right? For example, the value due to the technological obsolescence, or or there is a significant decline in market value of that particular asset. Like nowadays, EV is coming, right? And due to this increasing pollution, the diesel car demand has become lower. So, for example, I purchased a diesel car 5 years ago at a cost of 20 lakh rupees, right? And I'm charging depreciation. But if I want to buy a new diesel car, the value has gone significantly down, right? So if the value of the new asset has gone significantly down, there is a significant decline in market value. Again, it is an external indicator of impairment, right? And I'll give you a real life example here. I have purchased a Samsung S9 Plus phone, Samsung S9 Plus mobile phone in the year 2018, right? And that time I purchased that curve phone. I purchased that mobile phone at a price of 65,000 rupees. At a price of 65,000 rupees. Normally, the life of mobile phone is 3 years, right? So I depreciated this mobile phone over a life of 3 years. In the first year, the carrying value was how much? 65 minus 20, almost 45,000 rupees. So in the year 2019, at the time of Diwali, I was checking the price of that mobile phone on the Flipkart. And I found that after putting all the offers, sales discount, offers, credit card discount, the value of the mobile phone on Flipkart was 35,000 rupees only. 35,000 rupees. And my carrying value of that mobile phone after end of first year was 45,000. See, there is a significant decline in market value. Why? Because the technological obsolescence is there. The new technology, the new models are coming. So in 1 year, in 1 year, around 4 upgraded version has already been launched, right? So people want to buy the latest version, and that is why the for that old version the value has gone down, although the efficiency and performance has not gone down. So there is a significant decline in market value. It is again an indicator of impairment. So when I look at the Flipkart that it is only it is available at 35,000 rupees. Of course, it is an external indicator of impairment, and I need to estimate my recoverable amount. That what is my fair value less cost to sell, what is my value in use, and I need to take higher. If that higher is lower than my carrying value, if recoverable value is lower than my carrying value, I need to charge an impairment loss, right? I need to charge an impairment loss. Significant decline in market value is again one of the external indicator of impairment. Change in technology, big thing, yes. Change in technological, market, economic or legal environment is again an indicator of impairment. Ukraine. You must have heard about that Ukraine war, right? Have you heard about the Ukraine war? Russia and Ukraine war? Yeah, last year it was started. In Ukraine, the prices of the land has significantly gone down. Why? Why? Can you tell me why the prices of the land in Ukraine has significantly gone down? Due to war. Due to war. Because the situation is not good. People will not be able to live there, right? Due to this war thing. So friends, again, it is an external indicator of impairment. So let's say if I'm an Indian company and I have an investment property in Ukraine. So due to these external indicator, I need to do the impairment testing that yes, I need to impair my land. I need to estimate the recoverable value of my land in Ukraine. And if my carrying amount is more than my recoverable value, I need to reduce my carrying value and take it to the extent of my recoverable value, right? If there is a change in technology, again, it is an indicator of impairment. right? Change in legal environment, economic environment. For example, government has banned the output from that asset. Again, it is a indicator of impairment. Change in interest rate. If interest rates are increasing, inflation is increasing, interest rate is increasing, again, it is an example of external indicator of impairment. Sir, why? Why increase in interest rate is an example of external indicator of impairment, friend? For impairment testing, what you will do? For impairment testing, what you will do? Friends, for impairment testing, you will compute the recoverable value. And for computing the recoverable value, value in use is one of the leg of recoverable value, value in use. So what is a value in use? Value in use is a present value of future cash flows. Present value of future cash flows. Value in use is a present value of future cash flows, right? Value in use is a present value of future cash flows. So what is present value? It's a discounted value of future cash flow. Means you have to discount your future cash flows by a discount rate. What is a discount rate? It is an incremental borrowing rate. Discount rate is an incremental borrowing rate. Discount rate is an incremental borrowing rate. So let's say the future cash flow is 1 lakh rupee, right? And your interest rate, which is incremental borrowing rate, is 10%. What is the present value? PV is 1 lakh. And so what is your present value factor? First of all, what is your present value factor? I can say that equal to 1 divided by 1.1. This is my present value factor. Again, my future cash flow is 1 lakh only, but my discount rate is 12% because my interest rate has been increased. So in that case, what is my present value factor? 1 divided by 1.12, right? What is my present value of the future cash flow? What is my value in use? My value in use in this case is 1 lakh multiplied by this amount. 90,909. In this case, it will be 89,286. You can see by increase in interest rate, the value in use has gone down. Increase in interest rate, the value in use has gone down. Means the increase in interest rate is also an indicator of impairment. The increase in interest rate is also an indicator of an impairment, right? It is also an indicator of impairment. Low market capitalization. This low market capitalization is also an indicator of impairment. For example, the market capitalization, the value of the share of the entity is going down, right? Let's say the total assets of the entity is 10,000 crores, but the market value of the share is significantly gone down. It means the value of the entity is getting down. So this is again an indicator of impairment, external indicator of impairment. This lower market, you understand lower market capitalization? Market capitalization is equal to number of share multiplied by market value of share, right? Multiply by market value of share. Okay. Delta Corp is an entity into casino and gaming zone entity, right? So the government has come up with a higher rate of GST on these casino companies. So due to that negative announcement, the market value of Delta Corp, the market price of the share of the Delta Corp has gone down by 30%, by 40%, right? So this is again an indicator of impairment. Their market capitalization has gone down. This is again an external indicator of impairment. So friends, if this internal and external indicator exist, then only the company needs to do the detailed impairment assessment exercise for those assets or group of assets. But only in three conditions, in three assets like intangible asset having useful life, which is indefinite. Intangible asset not yet available for use. Goodwill arising in business combination. For these three cases, the company is not required to look for indicator of impairment. Rather, the company has to do the mandatory impairment exercise. Right? Have you understood this indicators, external indicator and this internal indicator? Have you understood that? Pradeep is saying, so Abdul is saying, sir, the discounting of 12% has to be calculated for the second year. So I have taken two scenario, Pradeep here, Abdul here. So case one, if it is 10%, then what is the present value? Case two, if it is 12%, what is the present value? I want to just show you that what is the impact of the interest rate. If there is an increase in interest rate, of course, your value will go down. Value in use will go down. Yeah. Is that clear, Abdul? Pradeep is asking, sir, so within quarter, we can do impairment this year and same we need to do in the next year, same quarter, but month can be different in that quarter. So that could be okay, Pradeep, that could be okay. Okay. Going by the reading of the standard, it is saying that same time. So generally it should happen in the same month, but practically it is okay if you are carrying out this exercise in the same quarter. Right, friends? So we have covered the first important aspect of this impairment standard. We understood the recoverable amount, impairment loss, identification of an asset that may be impaired, and we have also understood the exception to this impairment of asset identification. We discussed about internal indicator and external indicator, and we have also understood about what is meant by fair value less cost to sell and what is meant by value in use, right? So friends, it's 8:33 now. Let's have a 7 minutes break and we'll start at 8:40, right? questions? So now we'll discuss this fair value less cost to sell and value in use in detail, right? Although I have already given you the context that what is the recoverable amount, what is fair value less cost to sell, what is value in use, right? So this recoverable amount is higher of fair value less cost to sell and value in use of an asset in case of an individual asset. For a cash generating unit, which is a group of asset, so it is a higher of fair value less cost to sell of a CGU or value in use of CGU. Your higher will be the recoverable value of the CGU. This recoverable amount we have already covered. What is meant by fair value? So we understood that fair value is a market value. This definition is given under Ind AS 113, which is fair value is nothing. It's a price that would be received to sell an asset, price that would be received to sell an asset, or that would be received to sell an asset, or paid to transfer a liability in an orderly transaction between market participant at the measurement date. So fair value is a market price largely. Okay. Cost of disposal is an incremental cost. If the company will dispose this asset, then only this incremental cost will come. For example, transfer charges. If you will sell your vehicle, only then transfer charges will come into picture. If you will sell your building, only then stamp duty will come into picture, right? So cost of disposal is an incremental cost directly attributable to the disposal of an asset or a group of assets, excluding finance cost and income tax expenses. So cost of disposal is an incremental cost which is directly attributable to the disposal of an asset, which is directly related to the sale of an asset, right? Or a group of asset. And it does not include your interest cost, finance cost, and income tax expenses. For example, if you will sell an asset, you will be supposed to pay a 20% of capital gain, for example. So that income tax expense is not a cost of disposal, or finance cost is not a cost of disposal, right? If you would have taken a loan and you are paying a interest, right? So that finance cost cannot be a your cost of disposal, right? What could be the example of cost of disposal? Like legal expenses, stamp duty, similar transaction taxes, cost of removing the asset, right? Or direct incremental cost to bring an asset into condition for its sale, right? So these are the examples of cost of disposal. These are the example of cost of disposal, right, friends? Let's quickly do a case study on fair value less cost of disposal. Let's quickly do this case study. ABC Limited own a bottling plant located in one of its factory. So it's a plant, right? It's one of the plant which is located in one of its factory. The professional valuers have estimated that the current market value of the plant is 10 lakh rupees. The current market value of the plant is 10 lakh rupees. The valuation fee was rupees 1 lakh. The valuation fee was rupees 1 lakh. Friends, the market value which these valuers have estimated is 10 lakh rupees. And the valuation fee was 1 lakh rupees. And these valuers have charged a valuation fee of rupees 1 lakh rupee for estimating the market value, right? ABC need to dismantle the plant and deliver it to the buyer. ABC, this company, needs to dismantle the plant and deliver it to the buyer. Just read this question very carefully and just apply your mind. Okay. Dismantling cost is rupees 2 lakhs. Dismantling cost is rupees 2 lakhs. Specialized packaging cost would be 1 lakh and legal fee would be 0.5 lakh. Determine its fair value less cost to sell. Fair value is clear, it's 10 lakh rupees. What is my cost to sell? What is my cost to sell? What we have understood from the definition of cost of disposal or cost to sell, the definition of cost to sell means it's an incremental cost which is directly related to the cost of disposal. It is an incremental cost which is directly related to the cost of disposal, which is directly related to the disposal. Friends, whether this valuation fee is a cost of disposal, whether this valuation fee is a cost of disposal. Guys, I hope I am able to, you are able to hear me. I hope I'm audible and my screen is also visible. Can you please confirm that? My question was, my question was whether this valuation fee is a cost of disposal. Whether this valuation fee is a cost of disposal. Abdul is saying no. Rahul is also saying no. Neha is saying yes. What's your view, guys? What's your view? Abdul and Rahul, you are right. It is not a cost of disposal. It is not directly related to the disposal. For example, this valuation fee was paid to get the valuation done. Probably after getting or knowing the valuation, the company may decide not to sell this plant. The company may decide not to sell this plant, right? Or the company was not competent to get the fair value, and that is why they have engaged the valuers. Okay, so it is a sunk cost. It is a sunk cost. But once the company dismantle, why the company will dismantle that plant? The company will dismantle when if the company don't want to use that plant, right? So when the company dismantle that plant, it means the company wants to sell this plant. Okay, so this if I talk about this particular thing, so just think about the cost of disposal, whether the disposal cost is directly related to the disposal or it is something which is incurred and which is not directly relating to the disposal, right? So in this case, the valuation, in this case, the valuation fee is not a disposal, directly cost of disposal. This valuation fee is a sunk cost which has to be charged to the P&L. It is not part of your cost of disposal. But the dismantling cost, special packaging cost, and legal fee is 0.5 lakh. These are the cost of disposal. These are the cost of disposal. So in this case, the fair value less cost of disposal means or fair value is 10 lakh less dismantling cost, packaging cost, legal fees, right? 6.5 lakh. Friends, if I talk about today's scenario, if I talk about the question paper, the question paper is largely based on the practical requirement of the companies or industries, right? It is more of a practical based question, right? So more than just practicing the practical problem, more than practicing, I would say, numerical thing, it is again important to understood the concepts, right? Understood the concepts. I met with so many students, right? And normally what happened, so when I qualified in 2006 or 2007, when I qualified in 2007, around 16 years before, normally at that point of time, people do a lot of revision, people do a lot of, practicing a lot of numerical problem, and they can easily crack the exam. For example, if I don't know the concept, I just cram the concept and I just done the revision of, or let's say practice of 5, 6 question of the same concept. Right. I don't know the concept, but I've done the practice of 5, 6 questions from that concept, and whatever will come, I'll solve. Whatever will come, generally, question will come from that thing only, from in that manner also. But nowadays, the questions are more on the concept based, right? So you need to understand the concept very carefully, and of course, practice is important. I'm not saying you guys don't need to do the practice, or you guys don't need to solve these problems or questions. You have to do that. But nowadays, looking into the pattern of question paper, trend of question paper, nowadays the understanding of the conceptual understanding or understanding of the concept becomes very, 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 very important. So nowadays you need to understand that what is the concept. Okay. For example, I have seen people that if you will tell them, just calculate the impairment loss, and you need to tell them that carrying value is 100 rupees and fair value less cost to sell is 110 rupees, right? And you need to your manager has told you to compute value in use, right? And computing that value in use will take around 5 days. Okay. Or it will cost you, let's say, 1 lakh rupees. Okay. So what will you do? And what people says that, sir, the formula of recoverable amount is higher of fair value less cost to sell and value in use. And that is why to compare this fair value less cost to sell with value in use, I need to compute value in use also. But they forgot what is the objective of that, right? If already I have computed my fair value less cost to sell, and which is already more than my carrying value, I know that there will not be any impairment. There will not be any impairment because the recoverable value formula is higher of fair value less cost to sell and value in use. So it doesn't matter if my value in use is even lower, doesn't matter, because my fair value is already higher than the carrying value. Or if my value in use is higher than this fair value, even though it does not make any difference. Why? Because I have already concluded that my impairment will not be there. Then why to waste 5 days? Why to waste 1 lakh rupee of cost? Right? So normally what happens, if the question normally question ask in this scenario that the CFO has given you this thing, right? This scenario, CFO has told you to compute value in use because CFO was an old CFO and he understand that computing value in use is mandatory in case of assessment of recoverable value, right? And in the question, in the facts, it is given carrying value 100 rupees and fair value less cost to sell 120 rupees, right? And the question talks about that how many days it will take, how many cost it will take, and CFO is saying it is mandatory to compute value in use. So guys, in that case, you need to answer it very carefully. You need to answer it applying your bent of mind. You need to say that Ind AS 36 requires that impairment loss needs to be charged whenever carrying value is higher than the recoverable value. The recoverable value will be computed on the basis of higher of fair value less cost to sell and value in use. In this case, in this question, as per the facts given in the question, the fair value less cost to sell is already higher than the recoverable, already higher than the carrying value. So it is very much clear that recoverable value using fair value is higher than the carrying value, means there will not be any impairment. There will not be any impairment, right? If we will waste our time of 5 days or cost of 1 lakh rupee in computing or getting the value in use, it will not add any value to us. Why? Because even though if value in use is lower than the fair value less cost to sell, my recoverable amount will be higher and it will be equal to the fair value less cost to sell. Or if my value in use is higher than the fair value less cost to sell, still my impairment will not come into the picture. And that is why we need to advise the CFO that we should not go to compute the value in use and value in use, because we have already the fair value which we have already derived, or we are already having that fair value less cost to sell. It is more than the carrying value, and hence there is no question of impairment. And hence the company should not go to the detailed calculation of value in use or cost to sell. Right? Normally, the student who believe in the rotification or rota learning or ratification, they write the answer like yes. CFO is right. Impairment loss is calculated by reducing the recoverable value from the carrying value, right? And in case the carrying value is higher than the recoverable value, the value has to go down to the recoverable value. In this case, only fair value less cost to sell is given, and hence we need to compute the value in use, right? Have you seen the difference between what I have explained earlier and what I am writing now as a student? Have you seen the difference? Friends, nowadays the examiner or the industry expectation, right, or the question paper expectation is more understanding of the concept rather than the ratification or rota learning, right? So of course you need to solve so many practical problems. You need to do a lot of practice, but please remember the concepts very well, right? Remember the concepts very well. Is that clear? Is that clear, friends? Yeah. Yes, Rahul, you can say that, the yesterday paper was one of the toughest. Yes, you can say that. But don't worry about that. Remember two things. Number one, please understand the concepts carefully. Concepts are very important. Number two, do a lot of practice. Okay. But don't cram the concepts. Okay. Let's move on. Value in use. So what is value in use? It is present value of future cash flows, expected cash flow. Present value of expected cash flow. For computing value in use, two things are very important, right? Number one, of course, you need to expect your future cash flow. What is your future cash? Sir, how do we estimate that? Friends, normally the company estimates, the company have a contract, right? Or due to the past trend, the company will be able to estimate, that what would be my future cash flows in the next 5 years, in the next 10 years. The company will be able to expect that. Okay. Will be able to accept that. Will be able to estimate that. The second one is discount rate to be used. What is a discount rate? It is nothing. It's an incremental borrowing rate. Discount rate is nothing. It's an incremental borrowing rate. For example, the company has a borrowing. Okay. And the company is paying an average interest of 10% per annum. If today, and the company is talking about, assessing a value in use of an asset worth 50 crore rupees. Okay. And for 5 years, if today the company has to take a loan of 5 year, loan for a period of 5 year, what interest is going to be charged to the company? What interest is going to be charged to the company? What interest is going to be charged to the company? Right? So number one, let's say the bank will charge 12% per annum. So this 12% will become a discount rate. So number one, you have to estimate your future cash flows. Number two, you have to estimate the discount rate, right? So there could be a direct, clarification about discount rate in the question in the examination. For example, question says that the discount rate or incremental borrowing rate is 20%. Or the question will say that for a similar term, the bank normally charges 15% interest to such set of entities. In that case, the question talks about that this may be an incremental borrowing rate and this can be used as a discount. Okay. Friends, while calculating value in use, right? First of all, you have to estimate the future cash flows the entity expect to derive from the asset, right? Of course, you are doing a impairment testing for a particular asset like a machinery or a car, right? So you need to estimate the future cash flows only related to that car, only related to that car, only related to that asset, only related to that machinery, not the other asset. Okay. For example, you have two buildings. You are assessing an impairment loss of building in Ludhiana, and you have another building in New Delhi. So the Ludhiana building is not able to fetch good amount of rental, but Delhi building is able to fetch good amount of rental. So you cannot merge both this building. When you are doing the impairment testing of Ludhiana building, then you have to estimate the future cash flows only related to this building which is located in Ludhiana, right? So this estimate of the future cash flows is only related to this particular asset which the entity expect to derive. Okay. Expectation about possible variation in the amount or timing of those future cash flows. Expectation about possible variation in the amount or timing of those future cash flows. Right? While estimating the future cash flows, you need to estimate the amount of cash flow and the timing of the cash flow as well. For example, the life is, let's say, 10 year of the asset, and you are estimating the future cash flows for 10 years. So you need to estimate what amount I'll receive in the first year, what cash flow I'll receive in the second year, third year, fourth year, fifth year, sixth year, seventh year, eighth year, ninth year, 20th year. Why? Because the present value of the cash flow in the first year is much more then the present value of the cash flow is going to happen in the seventh year or eighth year or the ninth year or the 10th year, right? Because of this time value of money. Okay. So while estimating the future cash flow, the timing of the cash flow is again important, right? And other factors needs to be considered, such as illiquidity. Market participants would reflect in pricing the future cash flows the entity expect to derive from the asset. So, like inflation, so these things are also required to be considered while estimating the future cash. Okay, while estimating the future cash flows. So these are the elements to be reflected in your estimation of future cash flow. Friends, this is more of a theoretical part. Just you need to understand. Okay, value in use. What could be the basis for estimate? These are the element which needs to be reflected. What are the basis for estimate? For example, Rahul is an auditor and he went to a client, and client is doing an impairment assessment, and client has already computed the value in use, and Rahul is asking how you have computed your future cash flows. Is it only related to the asset? Have you considered that this cash flow will arise when, in which year? The client is said yes. So Rahul is saying that have you already considered the time value of money? The client is saying yes. Okay. And then Rahul is asking how you have estimated your cash flow, what basis you have taken. So standard says that reasonable and supportable assumption of management best estimate of the economic condition over the remaining useful life of the asset. The management should estimate, the management should estimate the economic useful life of the asset, and management should have a reasonable and supportable assumption that why management feels that yes, we will be able to have a cash flow of this particular amount in the economic life of asset. For example, let me tell you, friends, in telecom industry, specifically passive telecom industry, passive infra means the company which are installing towers, right? They have a long-term contract with their customers, like 10 years, 15 years, 20 years. So they are like in the annuity business. Okay. So when they are estimating their value in use, they are computing this cash flow or estimating the cash flow on the basis of contracts. And let's say their contract says that the 10-year contract is there, and every year there is an escalation of 5%. So if today the cash flow is 100 rupees, so in the next year they are considering 105. In the next to next year they are considering 111. So this is how they are estimating the future cash flows, right? So the management assumption should be reasonable and there must be a supportable assumptions. Okay. Greater weight should be given to the external evidence. Okay. So friends, while estimating cash flows, if you have some outsider evidence, so more weight, more importance should be given to the outside evidence rather than internal evidence. For let's say, the market trend says that, or there is a regulatory life or a contractual life of an asset is only 5 years. You are saying that no, we will be able to get this future economic benefit in the next 10 years. But the market evidence says that no, you cannot use this asset for more than 5 years. So you have to consider 5 years while estimating the future cash. Most recent financial budget or forecast that have been approved by the management needs to be taken. Standard says that most recent financial budget or forecast needs to be taken, right? Every year, normally what happens in the listed companies, every year, the management do this AOP exercise, annual operating plans, right? The management do this budgeting and operating and AOP exercise. And what management is doing, they are getting their budgets and AOPs approved in the board meeting, right? So this cash flow should be on the basis of most recent financial budgets or forecasts. And standard says the projection should cover for a maximum period of 5 years unless a longer period can be justified. It says that your projection should be for a maximum period of 5 years. The longer period you can take if it is justified. If it is justified. Otherwise, it should be a maximum period of 5 years. Is that clear? Is that okay? Is that okay? This is the basis for estimate. Is that okay, friends? Cash flows includes number one, cash flow should be estimated for assets in their current conditions. Number two, so that was clear basis for estimate. Says that now what you will include in cash flow. And my question to you guys, whether it is only cash inflow or if there are some cash outflow which is necessary to earn the cash inflow, whether that cash outflow is also considered or only cash inflow is going to be considered for value in use. Friends, whether only cash inflow needs to be considered or cash outflow is also required to be considered while computing value in use. Friends, the concept is present value future cash flows. Present value future cash flows. It does not talks about only inflow. It talks about inflow as well as outflow. You're right, Neha. It talks about inflow as well as outflow. It says that cash flow should be estimated for assets in their current condition. Right. Let's say the company has a fleet of cars. The company has 100 cars. Okay. And nowadays these cars are drive by drivers. These cars are driven by the drivers. And company is paying a salary to the driver and company is earning money from leasing these cars, from giving these cars on a rent basis. And the company is getting money from the customer and company is paying to the driver as well. The company will say that in next 5 years or after 2 years, there will be a concept of driverless car. There will be a robot car. There will be a concept of driverless car will be there. And company is saying that I would be able to save by these driverless cars. I will be able to save my future cash outflow by 20 crore rupees, let's say. Standard says that no, it is not allowed. Your cash flow should be estimated for the assets in the current condition. Like as of now, you are operating your fleet of cars by having the drivers. So आपको फ्यूचर में भी ड्राइवर को कंसिडर करते हुए कैश फ्लो आपको एक्सपेक्ट करना है, राइट? You cannot expect your cash flow considering your future will be a driverless cars. You cannot expect your cash flow accordingly. You have to cash flow from the asset for which you are computing value in use. You have to estimate your cash flow in the current condition of the asset. Right? Second, your cash inflow from the continued use of the asset. Number one. So in the same condition, in the current condition. Number two, your cash inflow from the use of asset. Number three, your cash outflow to earn this cash inflow will also form part of your thing. Okay? Fourth, your net cash flows, if any, to be received for the disposal of asset at the end of the useful life. For example, you expect the residual value, right? Apart from continuing use of asset, you are expecting that 100 rupees I'll receive every year. 20 rupees my cash outflow will be there every year. Net cash flow 80 rupees I'm getting every year. At the end of the life of the asset, which is, let's say the life of the asset is 10 years. So at the end of the 10 years, whatever net cash flow you will receive from the terminal value of the asset, which is a terminal value, scrap value, residual value, that value will also be taken into the consideration for computing value in use. Understood, friends? For example, let me discuss an example here for value in use. I hope this is visible. Ah, example, value in use. A company need to assess an impairment of the machinery. Company need to assess an impairment of the machinery having a life of 5 years. Cash inflow and outflow from the machine is given in the below table. The company will receive 50,000 upon 50,000 as a scrap value at the end of the useful life of the machinery. The company will receive 50,000 as a scrap value at the end of useful life of the machinery. Okay. The discount rate is 10%. Compute value in use. So number one, let's say here 1, 2, 3, 4, 5. Cash inflow 1 lakh, 2 lakh, and 1 lakh, 2 lakh 50,000, and let's say 2 lakh. Cash outflow 20,000, 50,000, 30,000, 20,000, 50,000. First of all, what is your net cash flow? First of all, this thing is given, right? So now we need to compute the value in use. First of all, you need to take net cash flow, right? You need to take net cash. What is my net cash flow? Net cash flow. What is my net cash flow? My net cash flow is 1 lakh minus 20,000. So let me compute my net cash flow here. Net cash flow. Sorry. This is my net cash flow. Okay. So let me link this from here. This is my net cash. And at the end of 5 years, there's a terminal cash flow also. At the end of the 5 years, there's a terminal cash flow of 50,000 rupees, right? There's a terminal cash flow of 50,000 rupees. Okay. Right? What is my present value factor? My present value factor is 10%. 1 divided by 1.1 equal to divide by 1.1, right? This is my present value factor. What is my present value? My present value is this multiply by this, right? You can see that I have computed my present value for this terminal cash flow also and these 5-year cash flow, net cash flow. This is my value in use. This is my value in use. This 535.64 is my value in use. This is my total. This is what I'll get as on today, right? Using this asset 530 564 is it what I'll get by using this asset. Is that clear to all of you, friends? How I have computed this? Is that clear to all of you? Huh? Whether this question is clear to all of you? Example of value in use. Is that clear to all of you guys? Friends, I'm not getting a response from you guys. At least you need to just provide your response. Any doubt? Any problem? Is that clear to you very clearly? Tanisha, Rahul, Viraj, Pradeep, Abdul. Is that clear in mind or not clear? Okay, three students have responded. So cash flow does not include what it does not include. As I told you, the future restructuring, like you said, that will bring driverless car. So future restructuring will not be taken into consideration. Improving or enhancing the asset performance. You are saying that my asset performance will be improved because I'll get a funds after 5 years, after 2 years, and I'll do this, that, and my asset position will improve in future. Answer is no. You need to consider your cash flow in the current condition of the asset, right? You can say that cash inflow or outflow from financing activity. For example, you are saying that I'll pledge my asset and I'll get a loan out of that. So if you're getting anything from financing activity, it will not be your cash flow from that asset, right? It will not be included as a cash flow from that asset. Okay. Or you can say that my income tax receipts or payment due to this asset which I have purchased, which I'm using, I'm getting a income tax rebate from the government. Or by selling that asset, I'm supposed to pay a 20% of capital gain. So these kind of cash flows are not a cash flows from the perspective of computing the value in use. Okay? These are not a cash flow from the perspective of value in use, right? Right? So you need to understand these things. You need to remember these things, that which kind of cash flow will be included and which kind of cash flow will not be included. Computing value in use is very easy, right? Very simple. But which cash flow you need to take, that is very, important. And you need to understand that which cash flow we need to take while computing or solving the problem in the exam. And this problem also comes into the real life, that while computing value in use, what you need to take, what you should not take, right? Okay. Discount rate is very simple, friends. Of course, discount rate depends upon the time value of the money and risk specific to the asset. Let's say if it is a real estate company, their rate of interest is higher than a company which is a IT company, information technology company, right? So discount rate is normally a pre-tax market rate. So you need to compute, you need to take the discount rate which is pre-tax rate. In the question, if pre-tax rate given and post-tax rate given, you have to take the pre-tax market rate. You have to take the pre-tax market rate, okay, as a discount rate. Friends, what is meant by pre-tax rate? For example, in the question, it says that your, let's say if 10% is an interest rate and you are a 30% tax paying company, right? You remember, if you will pay a interest on the loan, it is a tax deductible expenses. And if you're tax paying company, if you're paying a interest of 10%, you will get a benefit of 3%. How come it will be there? Because if you are paying an interest of 100 rupees, you will get a benefit in terms of tax by 30 rupees, right? So this 10% will become a 7%. This 10% will become a 7%, right? So your post-tax rate is a 7%, but pre-tax rate is a 10%. So in question, if your post-tax rate is given and your tax rate is also there, so make it before your tax, which is pre-tax rate. For example, in question it is given that the post-tax rate is 7%. and 30% is your tax rate. It means your 7% is equal to 70%. Then what is the pre-tax rate? 7 divided by 70% comes out at 10%, right? So you have to use 10% as a discount rate. Sir, how will we arrive at a discount rate? So it says that, first of all, if the entity, you need to take an entity weighted average cost of capital, right? Entity weighted average cost of capital. What is the weighted average cost of equity and debt, right? You need to compute the entity weighted average cost of capital. Normally it is given in the question. Okay. If the entity weighted average cost of capital cannot be determined, then you need to take the entity's incremental borrowing rate. For example, if the entity wants to take a borrowing for next 5 years, what is the rate which is going to be charged to this entity? Right? If that is not available, then it is a market borrowing rate. What is the market rate of interest? So that can be taken as a discount rate. Okay. Is that clear, friends? I hope it is clear to all of you. Yeah. Discount rate normally given in the question. It will be given in the question. Right. Is that clear? Very good. Friends, now discuss the, again, one of the important concept, foreign currency future cash flow. So we understood that what is meant by cash flow, and that cash flow needs to be discounted so that you will arrive at a present value, and that will be the value in use. I'm an Indian company and I have a building in USA, right? I have a building in USA. I am computing value in use for that building which is in USA for the purpose of impairment testing. Now that building will get the cash flow, since it is in USA, that building will get the cash flow in US dollar, right? And I need to compute that present value of the future cash flows as on today. Since I am an Indian company, I have an asset outside India, which is having a foreign currency future cash flows. So I need to, first of all, I need to compute the recoverable value in foreign currency. And then I need to convert that recoverable value in foreign currency, which is like a value in use, to Indian currency. And then I will get that whether impairment will be there or impairment will not be there, right? So friends, standard says that you need to estimate future cash flows in the currency in which they will be generated. First of all, for the asset which is outside India, you need to estimate the future cash flow only in that currency only in the foreign currency, only in the foreign currency, right? You need to compute only in the foreign currency. So calculate the future cash flows only in the foreign currency. Step number 2. Estimate the discount rate which is also applicable to the foreign currency. Why, sir? For example, in USA is a developed economy. India is a developing economy. In India, the rate of interest varies from 8% to 12%. In USA, the rate of interest is 2% to 3%. Right? Right. So if you go to Middle East, they people get the home loan at a interest rate of 4%, 5%. In India, it is 9%, 10%. So first of all, you need to compute the cash flows in the foreign currency. Then you need to compute or calculate the discount rate in the foreign currency only, which is applicable to that territory, applicable to that country, applicable to that currency. Then compute value in use in the foreign currency. You computed value in use in the foreign currency. Now you need to convert this value in use from foreign currency to Indian currency using the spot rate. From foreign currency to Indian currency using the spot rate. Using the spot. Right? Is that clear, friends? Is that clear? So, friends, let me take you through the Excel file and let me put all these steps here. Let me put all these steps here. I hope the Excel file is visible. I hope the Excel file is visible to all of you. Is that visible? Okay. Yes. Yes. So we are discussing how to compute the value in use for an asset which is outside India. So value in use calculation of foreign currency cash flows. Friends, step number one. What is my step number one? Calculate future cash flow in foreign currency only. Step number two. Estimate the discount rate applicable to the foreign currency. Step number three. Calculate value in use in the foreign currency. Step number four. Convert the value in use in Indian currency using the spot rate. Using the spot rate. These are the four steps. Now, let's understand this part with the help of the one of the case study from ICAI study material. On 31st March 2001, XYZ Limited makes following estimate of cash flows for one of its asset located in USA. Year 1, 2, 2, 3, 3, 4. The cash flow is $80, $100, $20. The cash flows are given. What was my step number one? What was my step number one? My step number one was compute the cash flow in US dollar. Right? What is my and what is given? Following information has been provided. Applicable discount rate in India is 15%, US at 10%. What was my step number two? Estimate or apply the discount rate applicable to that foreign currency. So step number two is 10%. Right? What is my step number three? Compute the foreign currency discount. Compute the present value of foreign currency cash flow using the foreign currency discount rate. Right? And then you will have a value in use. Right? And this company is doing this impairment testing on the reporting date 31st March 2001. Whatever value you will get, you will apply that foreign currency value in use to convert in INR. And the exchange rate on 31st March 2001 is given, which is 45 rupees per US dollar. Which is 45 rupees per US dollar. Okay. Right? Which is 45 rupees per US dollar. Is that clear? 45 rupees per US dollar. Calculate value in use as on 31st March 2001. As on 31st March 2001. So let me take you on the Excel file and there we will solve this problem. Practical problem. Solution of the study. What I need to do? First of all, what is the year? Year 2001, 2, 3, 4. This is the year which is given in the question. Right? What is my step one? What is my step one? Step one, calculate the future cash flow in foreign currency only. My cash flow in the foreign currency. And here my cash flow, US dollar cash flow needs to be taken. And it is given at $80, $100 and $20, right? 80, 100 and 20. What is my step number two? My step number two is discount rate. So estimate the discount rate applicable to that foreign currency only. I need to compute the present value factor 8%. Okay. This is 1 divided by 1.1 and it is divided by 1.1 and again it is divided by 1. Right? What is my step number three? Compute value in use. Compute present value in foreign currency. In foreign currency, that is present value in USD. Right? This is my present value in USD. Right? This is my cash flow present value in USD. This is my total cash flow is 200 in US dollar. But my value in use is 170.4. My value in use is 170.4. What is my step number four? My step four is convert US dollar value in use in INR using the spot rate 31st March 2001. That is my step 4. What is my spot rate? It is INR 45 rupees per USD. It is INR 45 rupees per USD, right? This is my spot rate. Okay. So what is my value in use in Indian currency? What is my value in use in Indian currency? Tell me. 170.40 multiplied by 45. 7667.9. This is my value in use in Indian currency. This value needs to be compared with the carrying value. And if there is an impairment, I mean to say if your carrying value is higher than the recoverable value, impairment needs to be charged. Impairment needs to be charged. Is that okay, friends? Is that okay? So friends, let's extend this question example and assume if fair value less cost to sell is also given in the question, then what is the recoverable amount? Right. So let's say the fair value less cost to sell is 250 US dollar. Let's say the fair value less cost to sell is 250 US dollar, which is given in the question. Right. So again, this fair value is at 31st March 21. So it has to be converted at the spot rate, right? It is a spot rate. So you need to convert it. You need to convert it into the INR. So 250 multiplied by how much? 45. It is 11,250. 11,250. And my value in use is 7668. Now what is my recoverable value? Recoverable value is higher of fair value less cost to sell and value in use. Higher of value in use and fair value less cost to sell. Which is higher? 11,250 is higher. So this will be your recoverable value. Right, friends? Right? Any doubt, friends, in this case? Any doubt? Abdul, is it clear? Tanisha? Rahul? Is that clear? I hope you guys have understood this thing. Yeah. This answer is also given on this in this presentation, right? Okay, friends. So, friends, today's class I'm concluding right now. Okay, and the next session, which is the second part of India's 36 on Saturday. So on that day, I'll take it little longer until 10:30, right? So in that class, we will be able to complete this impairment of asset standard. And as of now, we have understood the basic fundamentals of impairment of asset standard with the lot of examples of fair value less cost to sale, value in use, computing the value in use, right? And we have also covered this foreign currency cash flow case study, right? In case of a foreign currency asset, how will you do the impairment testing? How will you compute the fair value, less cost to sell or value in use, right? And how do you compute the impairment? Okay, friends. So if you have any doubt so far, I'm happy to discuss that. If you don't have any doubt, so I will be concluding the session right now. Okay. Do you have any doubt? Do you have any doubt, friends? No? No doubts? Okay. Then I'm concluding today's session and thank you very much. The next part will be covered in on Saturday, and that will be the second class and the last class on impairment of asset standard. Right? We'll do a lot of concept in that class. Okay. Thank you so much. Bye bye. Take care. Yes, sir.